Michael. I understand we're live and we're just going to give people a little time to get settled, maybe grab a cup of coffee or their lunch. This is the weekly 101, Building Wealth with Self-Directed IRAs and 401ks too, if you've got one of those. Thanks for taking time out of your day to visit. I think we can go ahead and get started now. Again, this is the 101 course. It's basics for beginners, but it's a good refresher. And we also have another course available at the website. It's a equivalent of a 102 course, and you might want to take that after you do this. So let's get started. First of all, there's a disclaimer. The lawyers have to have their say. So we don't provide investment advice. We can't recommend or promote or endorse any investment products. We're strictly the custodian and administrator of self-directed IRAs and 401ks. Anything that we tell you here is for educational purposes, and we encourage everyone before they do anything in this area to consult with their attorney, tax prep specialist, accountant, financial advisors before entering into any type of agreement or doing any kind of self-directed investments. So you've been warned. That said, we give you a little bit about ourselves. We've been around 20 years, and we're headquartered just north of Philadelphia in Ambler, Pennsylvania. I think it's the third exit off the turnpike. If you're familiar with this part of the country, we have about 8,500 clients across the country, all 50 states represented. We have about $1 billion plus in assets under management. And we're one of about 40 companies in this business. But we're big enough to get anything done. We're big enough to get anything done, but small enough to answer the phone. So that's one of the things we like to hang our hats on, is that we're committed to excellent service. If you're calling in to talk with us, you'll speak with a live human being. You're not some AI bot on a space platform, an Alpha Centauri. So yeah, we love answering the phone. We love talking about this stuff. So, we'll guide you through. I spend most of my time assisting people who are raising money. That's private equity, private lending, and venture capital companies, and making it easy for them and their investors to use their IRAs and 401ks. And so we kind of bridge the gap between the folks who are raising money, the folks that are putting together investment opportunities, and you. So we're big on education. This is part of it. We have a huge library of podcasts and webinars at the website. They live forever there. And it's a great library and resource for you to get started and to learn a bit about not only self-directed investing, but the different asset classes and everything about it. A bit about the founders who are still involved in day-to-day management of this company. It's a brother and sister team, Carl Fisher and Maggie Polisano, hence the CAMA. Carl was actually a rocket scientist, so he approaches this from an engineering standpoint. And Maggie has extensive experience in Fortune 100 environments, Fortune 100 IT platform building, and she's responsible for building out all the systems here that keep track of everything. They are a third generation real estate family. So they like to say that this company was founded by investors for investors, and that's very much the case. This is a very investor-oriented company, and there's a deep level of experience. Probably real estate is our biggest asset class. What do we do? The IRS requires you to have an administrator, custodian, a third party to monitor the activities in your IRA or 401k. So we're the neutral third party. We don't provide any advice. We're really no different than Vanguard, Fidelity, or Schwab. It's just that we're set up to do alternative assets. They can do stocks, bonds, and mutual funds. And it's a great place to do that. I still maintain an account at Fidelity where I do stocks and bonds. And it's great to be able to place a market order at night before you go to bed, and it out clears in the morning. We're set up to do everything else. That's apartment building, shares in business ventures, intellectual property, oil, gas, and mineral rights, all of the alternative assets that you hear about when you come into contact with self-directed investing. So we're a neutral third party. Again, we don't get involved. This is self-direction means self-direction. That means that you and the people you do business with are going to create the relationships and manage those relationships. So this is why we say you need to get advice from your tax prep people, your CPA, your lawyer if necessary, because everything takes place between you and them. I don't want to say like in the old Westerns, don't shoot us, we're just the piano player, but really we're just the custodian. So we record everything and keep you clean with regard to the IRS, but you're kind of on your own, but we'll help you in any way we can. We have enormous list of contacts and people who know a lot about the options available to you, and we can certainly put you into contact with them. And coming to our Thursday webinars would be a great way to get yourself introduced to those opportunities. So also, it's not unusual for us to be on calls with clients, advisors, their CPAs and their tax prep specialists. In some cases, they're lawyers. So don't hesitate to drag them into the process. We're happy to talk with them and explain what we're doing. We would want anything that you do with us to be a part of the plan that you and your team of professionals have created for your financial future. So we want to be part of that, complementary to that. So don't hesitate to bring them into the conversation. So today, we're going to talk about the different types of self-directed IRAs and 401ks. There are a number of them, and they do different things. Then we're going to talk about the types of self-directed real estate investments. We're also going to talk about other investments. Although real estate is the biggest asset class for us, there's a lot out there to look at. Then we're going to look at how an investment performs inside of a Roth IRA versus with your non-IRA money. And then once we go through that, we'll show you how the process works. If you wanted to actually do this, what are the steps? And then I'm going to give you some resources to help you get started. There's some downloads that we have at the end of this presentation. And of course, there's always resources at the website. So if you have any questions, let me make sure I'm getting them here. Don't hesitate to put them in the chat stream so that I see them, and I know Michael is kind of monitoring things and is hovering over in the background somewhere. So he'll let me know if you have any questions. But please don't hesitate to ask them throughout. I hate listening to myself drone on and on. So let's get started. All right. What is self-direction? There are a lot of claims about self-direction. And to the degree that you can buy and sell stocks and bonds and mutual funds at your brokerage account, there is a high degree of self-direction there. I can log on at night and go buy shares on the Hang Seng exchange in Hong Kong. I could buy bits and pieces of companies from all over the world. It's a tremendous universe of opportunity out there, but it is listed securities. And so that leaves the rest of the world, things like music catalogs or coffee plantations in Colombia. That leaves all of that as potential investments, which you cannot do through these types of accounts. So that's why custodians like us have set up the ability to do self-directed investments. And of course, what I mean by self-directed is self-directed. You're going to find them and you're going to do the due diligence on them and you're going to invest in it. Now, the key benefits are that you can invest in what you know and you achieve a higher degree of control over what you're investing in. Look at your own resume, the experiences you've had working, and you can see potential opportunities for alternative investments there. We get a lot of people who are real estate agents, people in construction who maybe participated in a fix and flip and as a contractor and now understand how that works and have become fix and flippers themselves. We have a lot of people from accounting and finance and banking because they understand lending and they come to this with what they know. We also have people who in retirement or near retirement have taken 401k money from a past employer and put it to work in the industries that they know best. So it offers a tremendous amount of opportunity to tap what you know and leverage what you already know. There are a bunch of different types of self-directed IRAs and 401ks, and they fall into two broad categories. One is the tax deferred. Now, among those are the traditional IRA. Many of you might be familiar with. You already have one or you had one. There are variations on that. For example, the spousal or inherited when one spouse passes away and leaves it to a beneficiary or the spouse. There are also plans for small businesses. There's the self-employed pension IRA and the simple IRA, which allow you to do 401k pension, 401k type pension type plans for you and your employees if you have a small company. Then there's the defined benefit plan, which we all remember as a pension. They still exist. And the defined contribution plan, otherwise known as the 401k, which many of you will probably be familiar with from plans that you participated in as an employee. The key differentiators for the tax deferred is that the government is encouraging you to put money into these accounts. So you get a little attaboy or an attagirl every year. You get a deduction for doing it, encouragement to put money away. And the money grows tax deferred. So that means that when you begin removing money from the account, you will pay tax and income tax at the rate that you were paying income tax in the year that you make your distribution. The distributions are allowed beginning at 59.5. So you make investments in these accounts and the wealth accumulates, the earnings accumulate, the capital gains accumulate when you sell assets, and it all accumulates tax deferred. And the thinking behind this account, this type of account, was that when you retired, you would move into a lower tax bracket. And so when you began taking money from them to pay for your expenses in retirement, you'd pay at a lower tax rate. Now, this isn't always the case, as many of us continue to work well beyond what was considered traditional retirement at 60 or 65. And because the government encourages you to do this and rewards you for doing it, they're going to take their share when you take the money out. You'll be required to start taking money out at 73, and that'll go up to 75 in the year 2033. So the metaphor here is that the government is going to subsidize the purchase of seeds, and you're going to plant them, you're going to water them, pray for rain, deal with blight, harvest it, take it to market, sell it, and the government's going to take their share, which is why they will begin requiring you to take the money out of those accounts at 73. So again, you get encouragement and you get rewarded for putting money into these accounts, but you will share what you create with the government when you take it out. On the other side of this ledger are the tax-free IRAs and 401ks. And this, the most familiar, is the Roth IRA. There are accounts for health savings and education savings, which allow you to invest in the same sort of assets that you would invest in with your self-directed Roth or your self-directed traditional IRA. And there's also a Roth-like 401k. And the difference here is that there's no encouragement for putting money into these accounts. These are after-tax contributions. And but they're allowed to accumulate tax-free. So the money you put in here and the investments you make and the income you generate and the capital gains you generate are all yours. You're not getting subsidized for your seed. You're buying it, you're planting it, you're watering it, dealing with blight, harvesting it, taking it to market, and then you get to keep everything. Probably the most prolific example of someone using a Roth IRA is Peter Thiel, who took his PayPal shares and he bought them with his Roth. And he has somewhere north of $1 billion sitting in a Roth account that will never be taxed. So there's no taxes on distributions and there's no required distribution. So you can leave this thing in there as long as you want. You could pass it on to an heir. You'll never be required to take money out of the accounts. So we like the Roths. We encourage you to go Roth if you can. We also can help you convert money on this side of the ledger to tax-free money through Roth conversions and backdoor Roths. So these are things we can get to later and help you with. Now, I mentioned what you can invest in, and it's again, the list of things that you can't invest in is a lot shorter. It's about a half a dozen, and I'll show you those in just a second. But we're most familiar with the real estate, and this is the ownership, direct ownership of property in all its forms. So not only rental properties, single family, multifamily apartments and condos, but also commercial property for businesses. We've got people that do land banking, Also, a big area is foreign properties. You've got people investing overseas as well, which you're allowed to do. And every variation of rental property, storage facilities, mobile home parks, recreational vehicle parts, the current trend for glamping, which is glamorous camping. These are all assets you can invest in. I saw a presentation a few months ago for someone that is offering, they're buying marinas, and they're doing the same things that early investors did with mobile home parks and with self-storage facilities. They're professionalizing it and adding new revenue streams to it, and it's an enormous opportunity. Now, there's some opportunities that are allied with real estate that are a little bit more passive, and these are buying and selling mortgage notes, lending money to fix and flippers. This is something I've done. I also buy notes, excuse me, and you can buy and sell notes and trust deeds. There's convertible notes, which you lend money and you have the option to convert it to equity. There's also there are also unsecured notes, and this is where you lend a business with very little collateral, if any at all. And any of these opportunities come in virtually every corporate formation, vehicle that you can think of: limited liability corporations and LPs, trusts, joint ventures and structured settlements, and in investment funds for accredited and non-accredited investors that are approved by the SEC. You can also invest directly in self-precious metals, and that means holding the metals not under your bed or in the tank of your toilet. It has to be in a depository, but you can hold metals and hold them in your name, and we arrange all of that for you. So if you've caught the gold bug, we can help you with some of that. More specifically, allowable investments. The first floor for our rental opportunities. Then there is improved and unimproved land. There's a company that I'm familiar with that prepares raw land for single-family home developers. They do the permitting, they do the title clearing, any remediation that has to occur as a result of what was taking place on that property beforehand, and then they sell it to single-family home developers in Texas, and they pay you a share of their profit on that. We've also got people investing in Colombian coffee plantations and Costa Rican vacation properties. So really, it's a very broad area. Again, I like the passive investments because I lend, and I don't have the expertise or the time to supervise direct investments in real estates like rental properties. So I like the passives because I don't get involved with what the landlords consider the 4 T's: the toilets, taxes, tenants, and trash. So I like these a lot. There are also leases. We have a guy that put a dump truck in his IRA, and you can think of that as just really mobile rental property. He put it in there and he leases it out to construction companies. He bought it with his IRA. So then there's debt converted to equity and unsecured notes. I have a colleague, really someone who's vended services to me and continues to do so today. And his business requires a little bit of front end loading, a little bit of extra push to get the raw materials he needs to make the product that he sells. And so I fund the front end of this, and he shares, when he sells the products to me, part of his profit. And so those are unsecured notes. Then again, every structure you can imagine. We see a lot more now activity in the investment club area. This is something you might want to check out, particularly if you're a newbie. I know I groped around trying to figure out how to evaluate investment opportunities and conduct due diligence, and it's always better traveling in a herd. There are real estate investment clubs all around the United States. So wherever you're living, there's one somewhere nearby, and it's great if you're getting involved in this for the first time and don't have the expertise, is to get together with people who have a mutual interest and let them share their areas of expertise with yours. I was just in a conversation last week where we're looking at a medical opportunity, and there were 2 doctors that happened to be in the group. One was retired, but still brought that expertise to the table. So you'll want to check out those. This being the IRS, There are some prohibited investments. Fortunately, the list is blessedly short. Um, Collectibles and life insurance. Okay, so you know, no works of art, fine art, or Persian rugs, or numismatic coins, Roman coins or Confederate uh, paper money, or any of that kind of stuff can go in your IRA. Anything numismatic, and part of the reason is these are highly speculative valuations, and so the IRS wants to know what's in your account when it comes to, especially when it comes time to start taking distributions from your account. And so these are highly speculative valuations. Two experts can look at it uh, at the same time and come up with wildly different valuations for them. No booze, so you'll have to drink the 61 Chateau Petrus yourself. But yeah, nothing like this. I think those of you who might be familiar with a show called The Antique Roadshow, it was filmed a couple decades ago, and then they came back and revisited. And it was interesting to see in the 90s how something which the experts acknowledged only a handful still existed actually lost value in the 10 years between the time they first evaluated that chest of drawers or the quilt that was 150 years old, and the time they revisited it again. So again, these are wildly speculative. Now, one thing you can do with coins is the U.S. government minted gold. So gold eagles and gold and palladium bullion, and it's not just the U.S. government. I mean, it's any sovereign. So you can put Krugerrands in there, and Chinese pandas, and Canadian maple leafs, and British sovereigns in there too. So a sovereign issued coin or bullion is eligible for it. And again, you would contract with a broker to acquire those metals. We'll help you with the transactions, and we'll help you with moving the metals from wherever the broker is purchasing them to a facility where they can be stored and documented for the IRS's purposes. Again, this being the IRS, there are a few other rules, and this involves who you can do stuff with. And I want to draw a distinction between investing in the people you see on this chart and investing with them. Let's talk about investing in. For whatever reason, parents cannot invest in their children's businesses or vice versa. I cannot invest in my spouse's business. She can't invest in mine. For some reason, I can invest in my brother's business, and I have. And my nephews, I've lent them money for their businesses when they were starting. Now, that's investing in. And one thing you can do with all these people is invest alongside of them or with them. So if I find a note and I can afford 80% of it and my wife can afford 20% of it, we may become partners on that investment. So that does not prohibit you from investing with anyone. It's just that you can't invest in them. And the main reason for the investing in is self-dealing. You can't invest in anything that benefits you directly other than as a passive investment. And so we have an entire section of the website devoted to this. We'll help you steer clear of the icebergs. It's not that difficult once you get the hang of it. But the deal is that the people in the blue boxes can't invest in other people in the blue boxes, but you can invest with them and anyone else. So my example would be my nephews, when they started their businesses, needed capital equipment. I was able to loan them the money at a market rate. And so it was great. I made a little money, but I was more importantly able to help them get their businesses started before a time when they qualified for commercial loans. So that worked out really, really good. One more note on self-dealing is you can't invest in anything that you own or control. Right now, probably the most frequent opportunity that we're asked to evaluate is investing in real estate that in some way the IRA account holder is going to benefit from. And so we get this question quite frequently, that the son or daughter is going away to school and dad wants to buy a condo, rent out the other bedrooms, and son or daughter will stay there for free. And you can't do that because it's too much of a direct self-dealing investment, and you're benefiting from it. Another one would be a vacation property, and where you can't, where you plan on trying to stay there 2 weeks a year. You can't do that anytime that you're going to benefit from this. You can't invest in companies you own, in companies you control. You can't be a 5% shareholder and control the company, be the spider at the center of the web, and that would be, that would qualify. It doesn't. So you have to be a minority owner, less than 50%. You can't be deriving any compensation from it. And again, talk to your tax specialist before you get involved in anything like this. We can give you the general lay of the land. We get these questions all the time, but you'll want to consult your specialist. All right, so we looked at the types of accounts and what they do, and we looked at all of these rules and regs about what you can do and what you can't do. So why would you do it? It's kind of all about the money. Most of us have had experiences here, unless we were, trust fund babies. We all went to work and we got 1099 or W-2 wages, and we had all these taxes taken out of them. And in some states, you might end up with less than this for every $100,000 that you make. But as you move up the value chain towards more passive investments, you get to keep more of it. All right, so when you're getting rents and royalties, that's different. You're not paying Social Security, Medicare, workman's comp, all that stuff. When you get into the IRAs, you get to keep all of it. Now, the tax deferred, you're going to pay income tax on it when you begin removing it from the account. But the important point is that you're able to accumulate wealth more rapidly than you would if the government were coming along and taking a bite out of what you're making every year, like this. We started out with $50,000. I can't remember what the appreciation rate was, and we wrapped it out over a few years. And as you can see, with the government taking a bite out of your non-IRA money, you're just left with a lot less at the end of the day. But if you move into the tax deferred or tax free, you can see how you end up quite a bit wealthier at the end of the investment cycle. Let's look at how this works for an individual investment. And again, we're trying to compare apples to apples here, so I'll point out some of the things along the way that make this a little interesting. So you have two owners of identical apartment buildings built the same year by the same company, and they're identical in every way, and they've been maintained. And one person buys it without using an IRA, and the other one does with a Roth IRA, right? And they generate $100,000 a year in rental income. Now, the person who bought with personal money, non-IRA money, is going to get a depreciation allowance. And there are some assumptions down the bottom here. And if you see anything that looks strange, please contact us. I mean, we're trying to make this a fair comparison. So you'll get the depreciation allowance and you'll pay income tax on the net. Now, again, we understand that there are expenses that are deducted. And so we couldn't come up with a common formula for putting an expense deduction in here. So that does exist. So your net income that's taxable, your taxable income would be lower in this case. But the concept works because you're keeping all of your money here and you're just having to give up money to the tax man here. And this goes on year after year after year. So it kind of compounds the advantages of having it in the Roth IRA. By the way, this isn't an either or. You can do this with you can take money that you have and put it alongside of your Roth money and put it into an investment. So you could take advantage of it with certain parts of your money and generate the net income with the other. The real magic happens when you sell it. Let's say you've held on to it for a number of years. And I think, I want to say we put in 10 years, but I don't remember the assumptions here. And we sell it for $3 million. Well, the person who owns the property outside of the IRA is going to get depreciation recapture, have to pay that. Then there's a capital gains tax, and they end up with a lot less money than, or significantly less money than the person who has it in the IRA. Now, understand the need that some people have to generate income from these buildings to actually pay current, expenses, that they make a living doing this. But the idea, again, is not either or. You can do it with your IRA money alongside of your non-IRA money. So you can see that's a significant bite out of the proceeds that you can avoid if you do this inside of the Roth. Let's see. All right, there are some differences in operating a piece of rental property inside and outside of an IRA. The traditional landlord, especially at the beginning, has his or her hands all over the property. They fix things. They respond to tenant inquiries. They really have their hands all over the property. They're painting and repairing and doing all sorts of stuff. But as they grow their portfolio, their number of doors in the parlance of the landlord business, they begin to employ or retain contractors to do some of this work, because they're not licensed electricians generally, they're not licensed plumbers generally, and they're going to run into things where you need those people. So they're going to begin to build a cadre of professionals that can handle the higher level stuff at first, and then perhaps everything. They'll have someone who is an admin to supervise interaction with the tenants. They'll build this out as they get their door count up. The IRA kind of fits into this in that it is a hands-off, arm's length dealing with the property. The property sits inside your IRA, and everything about that property is dealt with by your IRA. Your IRA pays the bills associated with it. If you're paying utilities, for example, you will pay taxes. That is paid by the IRA. You pay contractors and plumbers and everybody else associated with repair and upkeep. That you will pay from the IRA, and all of the rental income that you derive will come back to the IRA. So whereas in the traditional landlord model, you may be involved, this is a very hands-off way of doing things. But if you're headed towards building a portfolio of any significant number of doors, you're going to end up doing this anyway. So, why not? The principle here is that in the IRA's world is that you could pick the paint color of the house, but you can't paint the house. So you can't touch it and you can't repair it. Founder of the company, Carl Fisher, likes to joke about how it's almost like when he enters his rental properties, they need to tie his wrists with duct tape, so he's not tempted to touch anything in there. And it's kind of an extreme example, but it does demonstrate the principle. He said that also he was building his portfolio and had his eye on a piece of property he knew was going to come up for sale, but he missed a chance to bid on it because he was busy saving himself $25 an hour painting another one of his properties. So again, there are some differences in owning property directly versus owning it in your IRA. Okay, so we've gone over the types of accounts. We've gone over what you can do, what you can't do. We've shown you the money, which is significant. And we've identified a few of the nuanced differences of having a property inside or outside of an IRA. So how do you actually do this? This beautiful chart we can actually reduce to 3 steps. You're going to open your account, you're going to fund your account, and you're going to make an investment, like buy property or invest in a fund that does biotech or whatever it is you decide is an appropriate investment that fits your risk tolerance and fits where you want to go. So opening the account and funding the account can be done in about 20 minutes. If you have an IRA out there and at Schwab or Fidelity and you'd like to bring those funds over here, the online process takes care of the first 2 steps in about 20 minutes. If you have a 401k and you're rolling your money over to an IRA here, the same process takes about 20 minutes, but you'll go back to the custodian holding your 401k and you'll fill out a form there. And you'll have a new account number and some bank information that we'll provide you that will initiate the rollover from your existing custodian to us. So once your funds are here, and that takes about 2 weeks, we said typically 2 weeks. So keep that in mind when you're looking at closing dates, especially on direct purchases of real estate. After your funds arrive here, you'll be notified by email, and then you're free to invest. And we'll help you with assembling the documentation for your investments so that that's appropriately accounted for. We have someone who's spent 20 years closing real estate deals in IRAs, and she's expert at that, and we'll guide you through that. And we're familiar with all the other asset categories, that you might choose to invest in. So very easy to do. Only looks mysterious from the outside. There's a few resources we'll leave you with. This report is a lot of people particularly when I go out to the investor groups, they'll talk about, I only have a little bit of money, and the little bit varies, right? But you can make a little bit of money act bigger by pairing up with other people. I mentioned before that I often engage in an investment alongside of my wife on mortgage notes, for example. You can tap other people's IRAs. You can put your IRA together with non-IRA money. There are a lot of combinations that can make a little bit of money go a long way, and we have it in this report. And as I understand it, if you hold your phone up to the screen, it's like, I might be dating myself here, but it's like holding your lighter up at a concert. You'll be able to download this report, and it'll hopefully encourage you to to get started, because don't think you have too little money to get started in this. You can do this. Two other resources we have are a self-directed investing video. Now, this does in about 5 minutes what I just spent the past half hour yammering on about. So, take a look at it. It kind of recaps the process and lets you know what you can and can't do and how you go about doing it. So I'd suggest you download that, and it's the same thing. If you put your phone up to up to your screen, you should be able to do that. And we also have a podcast series called The Road to Financial Freedom, and an excellent producer who hosts that. And there you'll hear the stories of investors just like yourself who began the journey towards self-directed investing and financial freedom. So encourage you to do that. And Michael, if you're still around, I just want to make sure on this screen that I've got that I don't see any questions.
You'd be correct, yes.
Okay. All right. Well, one thing, the other big question that people ask is about fees. Let's walk through a typical account scenario where you've decided you want to do an investment and it's a self-directed investment. It doesn't matter what it is. It could be shares in a biotech startup or it could be an apartment building. It doesn't matter. You open your account, that's $75. Okay? You fund your account by moving money over from another institution. There's no charge for that. We don't charge anything to keep cash in the house. You make your investment. If it's a piece of real estate directly, it's $175. If it's any other asset, it's $150. And then depending upon how you move your money over to the investment sponsor, it'll be $10 for a check or ACH or $30 for a wire. So that's a pretty easy buy-in. There are annual maintenance fees, and it depends on the number of assets or the size of your account. We'll help you stay on the most economical fee basis for you. Per asset, it's $300. And I do this little math workup for people who are worried about the fees. Keep in mind that the typical full-service brokerage firm charges between 1% and 2% of your account value every year. And I've done this for countless numbers of our clients. I add up all the fees that they will pay in a year for everything they're doing. And then I divide it by the account balance. And it rarely comes out to more than 0.5%, 0.75%, sometimes 1%. So some folks are seeing fees for the first time that you normally don't see in some of these environments where a lot of fees are taken out before that net asset value is reported to your, you see it online when you log in. So you're seeing all of the fees associated with it. It's very transparent, but don't be intimidated by it. It rarely comes out to more than 0.5% to 0.75% of your account value. And if you're making the kinds of self-directed investments that most people here make, you're generating significant returns that more than cover that. So anyway, I want to thank you for your time. We do this every week, by the way. If you want to refresh, you want to come and see somebody else do it, that'd be great too. That's me. Feel free to reach out. If I don't have an answer to your question, I'll get an answer to your question. So again, thanks for spending time with us today. Take care and have a great day, everyone.